What's going on, everyone? My name is John with Value and Mortar, and I'm an economist. Today we're talking about what makes a great business. Last time we walked through how to analyze a rental property before you buy it. And one of the big ideas was that you don't buy a property just because the gross rent looks good. You have to get underneath that number and look at the expenses, financing, repairs, cash flows, and the risks that can change the economics. A business deserves the same kind of discipline. A company can be profitable right now and still have weak economics underneath. Competitors can copy what it does, customers can leave, costs can rise, or management can take those profits and reinvest them into projects that don't create much value. So today I want to separate a company that's making money right now from a business that has durable reasons to keep creating value. We're going to look at competitive advantages, switching costs, brand strength, network effects, cost advantages, pricing power, reinvestment opportunities, and return on invested capital. And then we'll put those ideas to work with Uber, including where the business looks strong and where it's more vulnerable. If you like learning how to evaluate assets from the economics up, subscribe to the channel. We're moving back into the business ownership side of things now, and the next step after understanding business quality is learning how to connect those economics to what a business may actually be worth. Quick disclosure, before we use Uber as an example, I do own Uber stock. That makes it even more important for me to separate what I may want to be true as a shareholder from what the evidence actually supports. This is an educational business analysis, not a recommendation to buy, sell, or hold Uber stock. Let's start with a simple distinction. Profit tells us that the business earned more than it spent over a particular period. That's obviously important because a company that never produces economic value for its owners has a major problem. But profit by itself doesn't tell the whole story. Imagine two businesses that each earned $10 million this year. Business A sells something customers can get from 20 nearly identical competitors. Customers can switch almost immediately. There's very little brand loyalty, and whenever business A tries to raise prices, customers leave. Business B also earns $10 million, but customers have a real reason to keep spending money with them. Competitors would have to spend years and a lot of capital to reproduce what the company has built. Business B can raise prices modestly when the costs rise without losing a large share of its customers. And it has several places where it can reinvest its profits at attractive returns. Same profit today, but very different economics looking forward. That difference is where the idea of an economic moat becomes useful for us. A moat is a durable feature of the business that makes it harder for competitors to take away customers or compete away the company's returns. The important word there is durable. Being first isn't automatically a moat, neither is being popular. Growing quickly isn't automatically a moat either. Even having a great product isn't automatically a moat if another company can reproduce the experience and convince the customers to leave. The real issue is what prevents competition from eroding the economics. One place to look is customer switching costs. And the switching cost doesn't have to mean that someone literally pays a fee to leave. It can be the time required to retrain employees on the new software. It can be years of historical data that's stored in the system. It can be the inconvenience of moving an entire workflow over to new processes. It can be a network of existing relationships which can disrupt other areas of the business if severed. Or it can simply be that changing providers creates enough risk and hassle that the customer would rather stay. When those costs are meaningful, a competitor can't necessarily win the customer over just by being a little cheaper. Low switching costs create almost the opposite situation. Customers can continuously compare alternatives and move toward whichever provider gives them the best combination of price, quality, or convenience. That's especially important when we get to Uber. Uber has tremendous scale, but opening another rideshare app on your phone isn't very difficult. Drivers can also work across competing platforms. Uber itself identifies low switching costs and competition for both customers and drivers as risks to its business. That doesn't mean that the network has no value. It means we have to distinguish network value from customer captivity. Brand can be another advantage, but brand is one of the easiest ideas to overstate. There's a useful cultural example here from the art world with Andy Warhol's Campbell soup cans. In 1962, Warhol created a work consisting of 32 canvases depicting the familiar varieties of Campbell soup. Part of what makes the artwork immediately recognizable is that the packaging of the soup cans had already become a recognizable piece of everyday American consumer culture. That gives us a useful distinction for business analysis. Recognition matters when it changes customer behavior. People search for the brand by name at the store or on Amazon. They trust it more quickly. They make repeated purchases. They accept to pay a modest premium over identical competitor products, or just require less persuasion before purchasing new products made by the brand. Those behaviors can improve the economics of the business. But recognition by itself isn't a moat. A company can be famous and at the same time have to discount aggressively every time a competitor lowers its prices. The financial question is whether the brand actually contributes to retention, customer acquisition, pricing power, or some other durable economic advantage. Network effects work differently. A network effect exists when the product or service becomes more useful as more participants join the network. A basic marketplace gives us the intuition. More buyers can attract more sellers. More sellers can improve selection for buyers. That improved experience attracts even more buyers. Uber has a version of this dynamic. More riders can create more earning opportunities for drivers. More drivers can improve availability and reduce wait time for riders. On the delivery side, more consumers can make the marketplace more attractive to merchants such as restaurants and supermarkets, while more merchants can give consumers more reasons to use the platform. Uber reported 208 million monthly active platform consumers and about 3.9 billion trips in the second quarter of 2026. The company also reported about $58 billion of gross bookings, which is the total dollar value generated across activity on the platform before Uber recognizes its own portion as revenue. That scale matters because local marketplace liquidity matters. If you open the app and there are plenty of nearby drivers, that can make the service more useful than a smaller network with longer waits. But here's why Uber is such a good test case. Uber's own annual filing cautions that these network effects may not necessarily result in lasting competitive advantage. Local supply and demand can matter more than the absolute size of the global network, and users can move between competing services relatively easy. So when somebody says Uber has a network effect, therefore Uber has a huge moat, the analysis is unfinished. The better question is, how much does the network improve the customer experience, and how difficult is it for a competitor to recreate enough local liquidity to remain viable? Another form of competitive advantage is cost. If one company can consistently produce or distribute the same value at a lower economic cost than its competitors, it has options. It can charge less and take share, maintain similar prices and earn a better margin, or use part of the savings to reinvest and strengthen the business. Industrial history and Henry Ford give us one of the clearest examples of this. At Ford's Highland Park plant in 1913, the company combined standardized interchangeable parts, specialized tasks, and continuously moving production into the moving automobile assembly line, rather than having workers repeatedly move around a largely stationary car. The production process increasingly brought the work to them. The important business lesson isn't simply that Ford built cars faster. Process improvements reduced the amount of labor time and production costs required per vehicle, which gave Ford more room to reduce prices and expand production. That's what makes an operational advantage economically meaningful. However, there's an important limitation, as the cost advantage only remains powerful if competitors can't quickly copy it or if the company continues improving faster than the rest of the industry. Yesterday's process innovation can become tomorrow's industry standard quicker than the innovators expected. Now we get to pricing power. Pricing power is the ability to raise prices, particularly when costs are rising, without causing customer demand or customer relationships to deteriorate enough to destroy the economics. That doesn't mean the company charges the highest possible price. A business can charge a high price because there's temporarily a shortage. Another company can raise prices because the whole industry is experiencing inflation. Neither one automatically has durable pricing power. Real pricing power usually tells you something about the customer's alternatives. Maybe the brand matters, maybe switching is painful, maybe the product is a very small part of the customer's overall budget, but extremely important to their operation or their life. Maybe the company has a cost advantage that lets it raise prices less than the competitors while still protecting its economics. With Uber, dynamic pricing is useful, but I wouldn't automatically call every search price evidence of pricing power. The platform uses pricing to balance rider demand with available drivers, and because customers can compare another rideshare service like Lyft, a taxi, public transportation, or other transportation options, Uber can't assume that every price increase will simply be accepted. Its filings specifically recognize that competitive pressure can force lower fares, lower service fees, promotions, or additional incentives. So the test isn't, can the company ever raise the price? The test is, can it protect or improve its economics without giving customers a strong reason to leave? Now that we know what competitive advantage is, we can connect it to one of the most important parts of the entire analysis, reinvestment. Suppose you own an excellent local business earning $5 million a year. It has great margins, loyal customers, and very little competition. That sounds wonderful. But imagine there's nowhere else for the company to put additional capital at a similarly attractive return. It can still be a valuable business, it can distribute cash to the owners, but the opportunity to compound internally may be limited. Now compare that with a business that can take a meaningful part of every dollar it earns and invest it into opening new locations, developing new technologies or products, expanding capacity, or deepening customer relationships that produce additional profit. That reinvestment runway can completely change the long-term economics. Uber gives us several places to think about this. Mobility created the core marketplace with ride-sharing. The delivery of food and other items expanded the relationship into another category. Then memberships, advertising, autonomous vehicle partnerships, and other services potentially give the company additional places to use its platform, technology, and customer relationships. But expansion isn't automatically good reinvestment. A company can grow revenue while putting more and more capital into mediocre projects that don't pan out. Growth only creates value when the returns on that incremental investment justify the capital and the risk being taken. That brings us to returns on invested capital. Return on invested capital, usually shortened to ROIC, asks how much after-tax operating profit the business produces relative to the capital tied up in its operations. Let's use a fictional example here. A company needs $100 of invested capital to operate and the business produces $20 of after-tax operating profit. 20 divided by 100 gives us a 20% return on invested capital. Now imagine the company can reinvest another $100 and produce another $20 of sustainable operating profit from that new capital. That's very different from a business that earns 20% on the assets it already has, but can only reinvest new money at 6%. What does this mean? A great existing business doesn't automatically have a great reinvestment opportunity. You want to understand both the return it has produced and the likely return available on the next dollar management puts back into the business. And those returns have to be compared with the company's cost of capital, meaning the return required to justify putting debt and shareholder capital at risk. If our fictional company can reinvest at 20% when its cost of capital is 10%, that investment has the potential to create value. If it's reinvesting at 6% against a 10% cost of capital, getting bigger may actually destroy value. This is why revenue growth by itself doesn't impress me very much. I want to know what the company had to invest to create that growth and what it's earning on that investment. Now, let's bring everything together with our Uber example. First, network effects. Uber clearly has scale. In the second quarter of 2026, it handled billions of trips across a platform used by hundreds of millions of consumers. Local density can create real advantages in availability and marketplace liquidity. But the limitation matters just as much. Switching costs are low, drivers can use competing platforms, and Uber itself acknowledges that network effects don't guarantee a lasting competitive advantage. Second, the brand. Uber has become a widely recognized name in rideshare and delivery markets around the world. Recognition can reduce friction when someone needs transportation in an unfamiliar city. But recognition only creates economic value if it contributes to repeat use, trust, customer acquisition, or some other behavior that competitors have difficulty reproducing. Third, pricing power. Uber has sophisticated marketplace pricing, but the dynamic pricing isn't the same as unconstrained pricing power. Riders can compare alternatives, drivers respond to earning opportunities across platforms, and regulators can also affect how pricing operates in particular markets. Fourth, cost and operating advantages. A platform operating across mobility and delivery can potentially spread technology, payments, mapping, customer support, advertising, and other capabilities across a huge base of activity. This may create efficiency smaller competitors have difficulty matching. But incentives, insurance, regulatory costs, customer acquisition, safety investments, and competition can all absorb those advantages. Fifth, reinvestment. Uber has potential reinvestment opportunities across delivery, membership, advertising, new geographies, enterprise services, and autonomous transportation partnerships. The question for an owner is not whether management can name more growth opportunities. It's whether those opportunities eventually produce attractive incremental returns on investment. And finally, returns on capital. I wouldn't reduce Uber to one ROIC number and declare the case closed because the calculation can change depending on how you treat cash, investments, acquired intangibles, and other balance sheet items. I'd rather track the direction of operating profitability, free cash flow, capital requirements, and the returns generated by new investments over time. Uber produced about $2.8 billion of free cash flow in quarter two of 2026. That tells us the platform is producing substantial cash today. But remember where we started. Profitability is evidence, it isn't the verdict. So when you're looking at a business, don't stop with is it profitable? Ask what makes those profits difficult to compete away. How costly is it for the customer to leave? Does the brand actually change purchasing behavior? Does the network become more valuable as it grows, and can competitors reproduce enough of that network? Can the company produce its product or service more efficiently than competitors? Can it protect pricing without destroying customer demand? And if it earns attractive returns today, how much money can it reinvest at similarly attractive returns in the future? That's the difference between looking at an income statement and thinking like an owner. A great business can have wonderful economics and still be a bad investment if the price you pay already assumes years of nearly perfect results. So in the next video, we'll take the next step. We'll connect business quality to intrinsic value, free cash flow, reasonable assumptions, and margin of safety so we can separate a great company from a great investment at the price available to us. If this helped you, like the video and subscribe please. We've gone from reading the financial statements to testing the quality of the underlying business. And next, we'll connect those economics to valuations so you can make a more complete long-term investment analysis. And drop a comment. Which advantage do you think is hardest for a competitor to copy? Brand strength, network effects, switching cost, or a real cost advantage? This has been John with Valiant Mortar signing off.